In this review video, we are going to look at review exercises 6-7, 6-8, and 6-9, dealing with the allowance for doubtful accounts. So in review exercise 6-7, it tells us that our company estimates uncollectible accounts as a percentage of credit sales, and they made credit sales of $1.5 million in 2019, and they estimate that 2.5% of its sales will in fact be uncollectible. So they want us to prepare the journal entry to record bad debt expense at the end of 2019. So on December 31st, we have to do a journal entry. So this is what we call our income statement approach. We are basing our estimate of how much we're not going to collect of accounts receivable based off of our sales that we've done on credit. So we did $1.5 million in sales on account, meaning accounts receivable originally. And we estimate we're not going to collect 2.5% of that. So our journal entry always to record our estimate under any method is a debit to bad debt expense and a credit to the allowance for doubtful accounts. Remember, allowance for doubtful accounts is a contra asset account, meaning it's conflicting or bringing down the value of a specific asset, in this case, accounts receivable. And that is what we use to net out our accounts receivable balance on our balance sheet. So our calculation is going to be that 1.5 million times that 2.5%. So we are going to put a bad debt expense on our books of $37,500, and we're going to put that allowance on our books at the same value. This is how much we're estimating we're not going to collect of our accounts receivable. It has to affect an expense account because we sold some of our inventory to a customer, for example. They left with that inventory with the promise that they would pay for it eventually. They aren't paying us, and we're not going to get that inventory back. So basically, by taking sales on account, by allowing customers to do credit sales with us, we're taking on that risk of not getting paid. And that's part of us running and operating our business. And expenses are what we have in terms of keeping our business running and operating, and things that we run into in terms of bad debt is an expense for us. The next one related to this information, it says at the end of the first quarter of 2020, they reevaluate their receivables and they decide that $8,500 that is due from the Mangold Corporation is not going to be collectible. So this amount was previously included in the allowance account at the end of our previous year, and they want us to journalize the entry to write off that accounts receivable. So we are looking to do this at the end of its first quarter that we have. So if we assume that their first quarter ends on March 31st, under the allowance method, which is required by GAAP, we debit our allowance for doubtful accounts for how much we are in fact writing off. And what we are writing off or eliminating is our accounts receivable for that specific customer in the amount of $8,500. Again, allowance for doubtful accounts, we debit it every time we write off a receivable. So at the end of the next fiscal year, we can really decide whether our estimating process in the previous year was good or not, because we're going to have something offsetting that credit estimate by those write-offs on the debit side. So we can actually end a fiscal year with our allowance for doubtful accounts before we do that adjusting entry, having a debit balance or a credit balance. If it has a debit balance, that would mean that we wrote off more in accounts receivable during the year than we had estimated in the prior year. If we have a credit balance, that means we actually did a little bit better than we had anticipated. We wrote off less in accounts receivable than we had estimated in the prior year. It's never going to be perfect because, again, this is an estimate, but it at least allows us to see if our estimating process was a good one. So if I have a huge debit balance and allowance for doubtful accounts at the end of the period, that means something was clearly very off with my estimating process, that I was so incorrect with my balance. So I have to go back and kind of adjust. If my allowance for doubtful accounts either has a debit or credit balance of a few $1,000s, then it gives me comfort that I can actually use that same estimating process that next current year because it was a substantially a good one overall. And then in the next one, in review exercise 6-9, it says, referring to the information in review exercise 6-8, on April 23rd, they actually receive a check from Mangold Corporation for the $8,500. So this is what we call a recovery of a write-off. I eliminated Mangold Corporation's accounts receivable balance, right? So think about those subsidiary ledgers that you learned about in Accounting 101. Every single customer has their own subsidiary ledger, so that we know at any given time how much we're owed from each individual customer. At this point, Mangold has a zero balance. We eliminated their balance. They've taken 5, 6, 7, 8 months to pay us off. And we said, you know what? It's just not going to happen. We don't think we're going to collect. We're going to write them off. It can happen that we have a recovery. And if there is a recovery of a write-off, we have to do 2 journal entries. The first entry has to reinstate the accounts receivable on our books. And then the second one is to record the collection of cash. So we have to put the accounts receivable for this company back on our books so that they do in fact have a balance with us. And we only ever reinstate the account for however much cash is given to us. So if this customer wasn't able to pay us the full $8,500 but sent us $5,000, we'd only reinstate the account for the $5,000. So you only ever reinstate for how much you've received. And they're no longer doubtful to us, so we put that allowance for doubtful accounts back onto our books. And then on April 23rd, we then also record the collection of cash and properly eliminate that accounts receivable from that customer of $8,500.